Good day everyone, we are from Group 2 and today we will presenting an analysis of two major convenience store chain in Malaysia, which are 812 Holdings Berhad and MN Holdings Berhad. This analysis focuses on interpreting the financial statements and financial ratios of 812 Holdings Berhad and MN Holdings Berhad. The purpose is to evaluate and compare their financial performance, liquidity, solvency and operation efficiency. Profitability ratios are analyzed to assess how well each company generates profit from its operation and shareholders' equity. Liquidity ratios are used to examine the ability of both companies to meet short-term obligations. Solvency ratio helps evaluate long-term financial stability and financial risk, while efficiency ratios assess how effectively assets are used to generate revenue. Finally, a comparative and trend analysis is conducted to identify performance differences and to assess the overall financial position and long-term sustainability of both companies within Malaysia's convenience retail industry.
Profitability ratio, gross profit margin. For 812, the gross profit margin declined slightly from 31.11% in 2003 to 30.86% in 2024. The marginal decrease indicates that while the company continued to maintain effective control over cost of sale and price strategies, it faced higher input costs and operating expenses in 2024, such as inflationary pressure and high procurement costs. Nevertheless, the relative stable margin reflects 812 strong economy of scale and bargaining power with suppliers. In contrast, MN recorded a lower and more volatile gross profit margin over the same period. This is mainly due to higher cost structure arising from fresh food operation, in-house food production and aggressive outlet expansion, which increased production of operating costs compared to 812. Net profit margin. The net profit margin of 812 declined sharply from 9.70 in 2023 to 1.3% in 2024, indicating a significant deterioration in overall profitability. This was mainly caused by rising operating expenses, higher finance costs and inflationary pressure. Despite stable gross profit performance, its exceptionally high margin in 2018 suggests the presence of favorable operating conditions or one-off factor that were not sustained in 2024. Meanwhile, MN net profit margin remained relatively low, reflecting thinner profitability. The lower margin is primarily due to high staff costs, logistic expenses, rental costs and the financial burden of rapid expansion, which continue to suppress net earnings.
Next is return on equity, which for 812, return of equity declined sharply from 75.60% in 2021 to 11.25% in 2024. This significant drop indicates that the company is generating much lower returns for its shareholders. The main reason is a sharp fall in net profit, which may be caused by higher operating costs, rising expenses or weaker sales performance. As a result, shareholders receive lower returns compared to previous year. On the other hand, MN company shows a slight improvement in return on equity, increasing from 2.43% in 2023 to 3.61% in 2024.
So now I will explain about inventory turnover. The inventory turnover of 812 improved from 4.04 times in 2023 to 5.21 times in 2024, indicating faster inventory movement and improved stock management. This improvement may be attributed to better demand forecasting, improved supply chain efficiency, and recovery in consumer spending. In contrast, MN recorded a lower inventory turnover, mainly due to the complexity of managing fresh fruit, bakery items, and multiple retail formats, which slow inventory movement and increase the risk of the inefficiency. So now we will move into receivable days. For 812, receivable days decreased slightly from 96 days in 2023 to 89 days in 2024, indicating a modest improvement in receivable collection efficiency. However, the relative long collection period suggests continued reliance on credit arrangement with business partners. Meanwhile, MN maintained relatively stable and shorter receivable day, reflecting tighter credit control. However, given its weaker liquidity position, any delay in collection could have a more significant impact on cash flow.
Liquidity ratio. Current ratio for 812, the current ratio declined from 1.1603 in 2023 to 0.8839 in 2024. In 2023, the ratio above 1 indicates sufficient current asset to meet short-term obligation. However, the decline below 1 in 2024 suggests increased liquidity pressure, likely caused by higher current liabilities, increased operating costs and greater reliance on short-term financing. In comparison, MN consistently recorded a current ratio below 1, reflecting tighter liquidity condition. This weaker liquidity position is mainly due to aggressive store expansion, higher short-term borrowings, and substantial working capital requirement. Quick ratio. Similarly, 812 quick ratio decreased from 0.8437 in 2023 to 0.4862 in 2024. Indicating a reduced ability to settle short-term obligation using liquid assets excluding inventory. This decline suggests heavier reliance on inventory and weaker immediate liquidity in 2024. For MN, the quick ratio remained consistently low, reflecting a high dependence on inventory and limited liquid asset, largely due to cash outflow associated with expansion and food production operation.
So now we will move to the gearing ratio. The gearing ratio of 812 increased slightly from 74.64% in 2023 to 75.55% in 2024, indicating a marginal increase in relation on debt financing. This reflects continued use of borrowing to support operation and capital expenditure, which increase financial risk. In comparison, MN also shows an increasing gearing trend, driven by debt fund expansion and new outlet opening, which raise a long-term solvency risk if not supported by sustainable profit growth. So for the last one, we will talk about debt to equity ratio. Similarly, 812 debt to equity ratio increased from 293.6% in 2023 to 308.8% in 2024, showing that debt continued to significantly exceed shareholder equity. This high leverage indicated elevated financial risk, although it may ensure returns during profitable periods. For MN, the debt to equity ratio is also rising, reflecting increased dependence on borrowings to finance rapid expansion. This exposed the company to higher long-term financial risk, particularly if earnings do not improve proportionately.
And now I would like to explain about financial statement conclusion summary. 812 shows strong revenue and market presence due to its large store network. However, its net profit margin and ROE are highly volatile, mainly because of higher operating costs and heavy debt exposure. Liquidity also fluctuates, indicating short-term financial pressure, while declining inventory turnover suggests weaker operational efficiency. In contrast, MN operates on a smaller scale but demonstrates steadier improvement, although its net profit margin remains under pressure from expansion costs. ROE is gradually improving. MN also has lower gearing, better liquidity, and more efficient inventory management, which reduce financial risk. As a result, in terms of strength, the company demonstrates strong gross profitability, which gross profit margin remains high, peaking at 31.11% in 2023 and staying strong at 30.86% in 2024, which reflect effective pricing and cost control. 812 also benefits from operational scale, with inventory turnover remaining above 5 times in most years, indicating steady sales volume. In 2023, profitability peaked with the net profit margin at 9.70% and ROE at 75.60%, showing the company's ability to generate high return under favorable conditions. However, there are key weaknesses, which earnings are highly volatile, as net profit margin fell sharply to 1.32% in 2024, mainly due to higher operating and financing costs. Next, liquidity pressure is evident, with the current ratio dropping below 1 and a low quick ratio, indicating reliance on inventory to meet short-term obligations. And lastly, cash collection is also weak, with receivable days increasing to 89 days, while high debt to equity of 308.8% highlights significant financial risk from heavy debt dependence. In conclusion, 812 has strong scale and gross profitability, but its performance is constrained by earning volatility, liquidity pressure, and high leverage. However, there are 4 key ways to counter this. First, the company should improve working capital efficiency by strengthening receivable and inventory management. High receivable days and slower inventory turnover show that too much cash is tied up in the operation. Second one is financial risk should be reduced by gradually lowering reliance on debt. The very high debt to equity ratio increase interest burden and overall financial risk. And the third one is short-term liquidity need to be strengthened. With both current and quick ratio below 1, the company should build stronger cash buffers to meet short-term obligations. And finally, earnings should be stabilized through better cost control. The sharp drop in net profit margin highlights the need to manage operating and financing costs more effectively. Overall, these strategies aim to improve liquidity, reduce risk, and stabilize profitability in the long term. Thank you for watching.